Hi there, it's Bill with Smart Trades. It's August 4th, Wednesday, around 11:25 Pacific time, and I'll try to keep this report a little briefer, but there is a lot of ground to cover, and one of the things I'd like to discuss is my long-term count, because there's some confusion, and perhaps it's my fault in terms of me thinking or people thinking that I'm saying the bear market is over, and that's not the case. I don't believe that, but I do believe that it is likely to be more of a sideways bear market than a lot of folks do, and so I'm going to discuss that. But first, here's just a quick review of various turning points or expected turning points in the market. Basis the Dow over the years. There's been calls for tops at Dow 2700, then around 3800, and again around 5800. And at each of these turns, it's been cited that this is the perfect Fibonacci target and resistance, and we're at a trend line, and you name it, the count is complete, and so on and so forth. Now, there's no shame in getting this wrong. I mean, anybody that's ever done any kind of market analysis has missed the top. Said it's the top, and the market's kept on going. But from an Elliott wave perspective, if you do that, what you really want to look at is, okay, why is the market going through my targets? And in this case, the first target around 2,700 or so on the Dow. From there, the market has since rallied 500%. Basis the NASDAQ, it's much more than that. And so what you want to ask yourself is, why is the market up 500% from quote unquote the perfect target? Well, more than likely what the case is that you're counting a fifth wave when you should be counting the market as only being in a third wave. And indeed, I think there's a lot of evidence that this acceleration here is in fact a third wave rather than a fifth. And pretty much everybody else out there, both famous and not so famous, is counting this as a fifth wave and saying that we topped back in 2000. That's not the way I see it. It's certainly possible, but I favor that we're into a big sideways fourth wave style correction. And anyway, as I've noted in the previous reports, we have an A down, B back up, and C down. Now, I don't believe that's the end of the bear. I believe more than likely this is around the midway point, actually. It could be an expanding triangle, in which case we're actually going to eventually go up and make new highs and then come back down below 6,000. I would note here, too, that area below 6,000 is quote-unquote perfect resistance back in 1996 or so, and around the 5,700 area. And so, as is so often the case, what was resistance in the future becomes support. I actually had a whole variety of targets back in 2008, 2009, around that 5,700 area. The Dow never reached there, so perhaps we'll reach there in leg E of an expanding triangle. Okay, here's a blow up of that chart, and again, here are those targets in the Dow. Here is that trend line. If we do in fact have an expanding triangle, again, new highs, perhaps over 15,000, and then down briefly under 6,000. This is all several years out, so we'll adjust this as we go, and let's not sweat it too much right now. Here's another variation. Here again are those peaks, basis the Dow, and in this case scenario, we've got our ABC down is just A of a contracting triangle. So we'd rally back up, make a lower peak, a higher low, a lower peak, and yet another higher low. Again, the ultimate triangle probably won't end till sometime between 2015 and 2020. So let's be patient, and we'll take it as it comes until then. Now, here's something I think rather important. This is a copper spot index, and what I've done here is put linear regression channels around the market. These actually are parallel, but because of the log scale, they appear to be contracting. The bottom line is, we have this big decline back into early 2009, late 2008. And from there, what I see is a very much impulsive rally. And again, using those regression channels, we have an ABC down, in my opinion, or at least part of one. And so we have an impulse up, what looks like a corrective pattern down. Here's a little more of a blown up view of that again, A down, B back up, and what looks like to me probably a series of 1-2s and an acceleration to the upside in spot copper. Now this is important because if the world economy is grinding to a halt, why is copper accelerating to the upside? And the answer to that, in my opinion, is the world economy is not grinding to a halt here. So again, one of those things that we'll just have to wait and see about. Here is an update of the chart that I posted back in early May, calling for a bottom, or at least a target, I should say, for the S&P down around 1030. And in here, let's go a little further. And here's a blow up of that chart. And additionally, we can count 5 waves down of A, 1, 2, 3, 4, 5, a B wave back up, and then 62% of A comes in right around the closing lows so far in the S&P. I put this out there because the possibility exists that this is a completed correction already. I don't necessarily favor that, but it's certainly possible. And here's the scenario I favor, is that the correction so far down is just A. We're rallying back up in B. And my ideal target at the bottom of this channel, and an A equals C scenario from approximately where we are right now on this B wave, would be around 950. Maybe a little above, maybe a little below. We'll have to wait and see again. But that's the basic pattern that I'm looking for. And basis the S&P cash hourly. Here is the popular ascending wedge C wave pattern that everybody's looking at. The one problem I have with that is everybody's looking at it, and the market usually doesn't do what everybody expects it to do. That said, the area around 1140 is going to be very interesting should we get there. If we were to fail from there, I certainly would look at the short side. And here's an alternate, a very similar pattern actually, with a similar target. However, it's a different count, and in this count, the entire decline to the late June low is an A, and from there we have an ABC back up. And from point B here, I count 1, 2, 3, 4, and that we're working on a 5th wave now. Now this allows the market to go a little bit higher, perhaps to 1146 or so. And that 1146 target is two things. It's an A equals C, and it's also wave 3 and wave 5 are approximately equal there. And there is a tendency in Elliott for 2 waves in a 5-wave sequence to tend towards equality. So 1146 or so, interesting if we get there. A lot of people might be thinking that the wedge is broken at that point, so it might be a tricky secondary resistance point to watch for. There is a little overlap here, but not on a closing basis, and I would remind you that both Prechter and Elliott used hourly close only data, and we're not concerned with intra-hour overlap and so on and so forth on their counts. And finally, here is the spiders. I'll bring your attention to this gap. I believe this is back on the 13th of May. I may be wrong about that. I have to take a second look. At any rate, that comes in about 116 basis the spiders, 1157 basis the S&P cash. I bring this to your attention because basis the S&P cash, you do not see this gap because again they calculate the S&P cash incorrectly on the opening. They use unchanged issues to calculate the index, and as a result, oftentimes gaps that are actually there in the market do not appear on the S&P cash. So, long story short, if we break through the other targets, 1140, 1146, this gap will be something to watch. And again, it comes in around 1157 basis the S&P cash. That's it for now. Hope you're having a great day. Talk to you soon.